This is the last in the series of financial measures related to the subcategory of profitability. This one is referred to as something called an operating profit margin ratio, oftentimes abbreviated OPMR. The operating profit margin ratio actually takes your net farm income from operations, it adds the interest back, so we're dealing with the farm as if it has no debt, and then it subtracts the opportunity cost of unpaid family labor. Now that should be very familiar to you because we use that in the determination of the return on assets. But in this case, it's the same exact calculations, but instead of calling it return to assets or calling it adjusted net farm income, it's referred to as the operating profit margin. So you see, we've got one calculation that's actually referred to as three different things. So the operating profit margin is equal to net farm income from operations plus interest minus the opportunity cost of unpaid family labor. Now we've calculated that two other times. One time we called it adjusted net farm income, okay? And one time we called it return to assets. The thing you need to remember that that number is an estimation of the profit on the farm without interest and with an allocation to pay the unpaid family labor. So the operating profit margin ratio is equal to the operating profit margin divided by total revenue. So really what we're doing is we're finding out what percent of total revenue is the operating profit, which again is the profit without interest and with an allocation for the unpaid family labor. So in our farm it's equal to 230,831 divided by total revenue, which is 761,289, which gives me, that turns out to be 30.3%. So 30.3% of the total revenue that J&J Farms generated in 2014 was equal to operating profit margin. And again, that operating profit margin is equal to the profit as if there was no debt and with a payment for unpaid family labor and management. Okay? So of course the higher that number, the better your the, the, the higher that percentage, that simply means you've got a lower percentage of operating expenses and that your revenue is a large percent of profit without interest and with a payment for the unpaid family labor. Okay, this particular operating profit margin ratio is the last in the profitability measures. The four profitability measures that we've covered in here are return on assets, return on equity, cost of debt, and operating profit margin. Don't get confused about this concept of calculating one number three times. And one time we call it adjusted net farm income, one time we call it return to assets, and one time we call it operating profit margin. Don't let that confuse you. It's the same number, and that number is simply represents the profit of the farm minus, with the interest added back, so it's as if there's no debt, and with an allocation to pay the unpaid family labor because that labor it does have a value. Okay, this ends up the financial measures for profitability.